Without further ado, we'll get started on the presentation. So I've done this presentation. First off, I'm a huge fan of US taxation of foreign pensions. It's a fascinating topic to me. I don't know why. Maybe it's just the tax nerd in me or something, but when I first learned about this issue, it was kind of mind-blowing because I was like, wow, you would think that all retirement plans would kind of be treated equally and the same, but under the Internal Revenue Code, that's definitely not the case. And so when you meander outside of the very nifty 401 rules, everyone knows about the 401k, obviously, you can get into some very tricky areas, and there's a lot of caveats and divots and ins and outs. So one thing to understand about these rules is that they're very antiquated, they're quite old, and what really needs to happen is that the Congress needs to update them, or they need to pass new legislation updating these rules. They had a golden opportunity to do it with the Tax Cuts and Jobs Act. They chose not to do it. I'm not sure why they didn't do it, but they should have done it back then. They need to do it now. We have even with COVID-19, we still have a very global mobility society and folks across borders. So this issue will continue to pop up for a lot of people that have US tax reporting. And so it definitely needs to be dealt with. You'll see in the presentation that there has been a little bit of headway recently. Back in March, there was an updated procedure that was passed that I'll talk about. We'll talk about the good and the bad with that. But in general, there definitely needs to be more progress made in this area. The presentation is meant to be a very general presentation. So not every single foreign pension plan will have a direct way of falling into the rules. And so you have to be very careful about taking the general steps that I'm going to give you and then applying it broadly. For example, I had a question pop up today about several Indian pension funds. There was the Employees Provident Fund, the Public Provident Fund, the National Pension System. Those all have a different method of treatment and can permutate in a couple different directions depending on the facts and circumstances. So it's important that you really, once you grasp the understanding of the rules, that you try to apply them specifically to the different pension asset that you're trying to look at. At the Wolf Group, we've developed basically a three-step process, though, about how we approach foreign pensions. The first step is to classify the pension. You always want to know what kind of pension you're dealing with. The second step is determining the taxation, if any, of the pension. And then the third part is actually putting pen to paper and reporting the pension either on the tax return or some kind of international informational filing. A little bit of background about foreign pensions. For the most part, the way that you want to kind of center your mindset on foreign pensions is that they're all going to pretty much follow a three-part pillar system. And this is very typical in Europe. You'll see, even in Switzerland, it's basically called Pillar 1, Pillar 2, Pillar 3, as you can see in kind of that on the side of the slide there. That's how they break out their pillar system. But within those pillars, Switzerland has 1A, 1B, 2A, 2B, et cetera. The rest of the world is pretty much modeled very similarly to that. They may not call it pillar or the pillar system, but they basically have a three-tier setup. The first tier or tiers are typically going to be the equivalent of US Social Security. The second tier is going to be some kind of employer mandated or government mandated employer retirement plan. And then the third is typically going to be a self-directed plan, similar to a US IRA, some kind of voluntary or self-directed plan that a lot of people can access within that country. So definitely you want to center yourself on that. When I get kind of a new country that I've never seen before, I always like to go to the OECD and see what they have on file, because they always do a good comprehensive review of different countries' pension systems. Obviously, Google is going to be your best friend on that as well, but you have to take whatever Google gives you with a grain of salt. You really need to investigate it yourself. And then a lot of times what I will also do is I will kind of run my thoughts about the way I'm interpreting the pension system by our Non-HCE international network colleagues across the world. So if, for example, I have the pension issue in India, I can always reach out to Chakravarti Singh in India and say, hey, this is the way I'm interpreting the national pension system for this client. Do you see it the same way? Just give me a thumbs up or thumbs down. And they're always pretty good about coming back to me with that. Here's a more linear representation of the pension system. I think some people see it better on a chart. So this is, I think, a helpful way to kind of look at it as well. Okay, so getting into the steps here. So step one, classification. The first thing you have to know is that basically a pension can be one of three things, or we try to classify it as one of three things. I think there's a couple other versions you can get for key partners or whatever, but those are rare. typically it's going to be either a defined benefit plan, a defined contribution plan, or some kind of voluntary plan. So you really have to understand your terminology as you're looking at these pension plans so that you're properly putting on the right type of classification. The first thing to note with a defined benefit plan is that it's kind of like a dinosaur. It's still kind of there. We can see remnants of it, and it's part of the old way of doing retirement planning. What would happen is that people would, set up these defined benefit plans, and they would say, in lieu of paying you more compensation, we're going to give you this great defined benefit plan that's going to give you a benefit over a long period of time. The problem with that plan, though, is that it's not sustainable, at least not for the current society when people are living to be, 80, 90, 100 years old. The defined benefit schemes were thought of at a time when, hey, folks are going to live to be 50, 60, 70, maybe max. And so over time, those have really become unsustainable for a lot of countries. And a lot of private employers have moved away from defined benefit plans. So typically I'm speaking to, someone that is not a young person, I shall say. If they're not, if they're kind of older, they may have the defined benefit plan. We're seeing a lot of these kind of being converted in the UK right now. They're kind of doing the lump sum. They're taking the defined benefit, putting it into a lump sum, and then saying, hey, do you want to take it out or do you want to roll it over to a SIP? So that's kind of the background with defined benefit plans. Defined contribution plans are the ticket of the day. These pretty much represent a lot of employer plans throughout the world. In the United States, this is basically a 401k. So what happens is the employer contributes a certain portion, the employee contributes a certain portion. In the United States, it's kind of depending on what your employer plan says. In different countries, they may be very specific, like the employer has to contribute X and the employee has to contribute Y. But basically, you want to understand what are the employer-employee contributions. And as we'll learn later on in the presentation, this is a very critical element to understand when it comes to defined contribution plans. The last type of plan is going to be the voluntary or self-directed plan. And this is a very tough thing to kind of understand because sometimes you'll go through and you'll look at a country's pension system, and it's difficult to know, is this really a voluntary plan or is it something else? And so in India, for example, the public fund, the PPS, I think it's called, or PPF, is a good example of one that, in my opinion, likely falls into this category, but could also be construed as a Pillar 1 plan. So you really kind of have to look closely at it to make sure which way you're going with it. Most common examples of ones that we know are definitely going to be voluntary or self-directed plans are going to be the UK SIP. We know that one for a fact. The Australian self-managed superannuation fund, self-managed being the key word there. The Swiss Pillar 3A or 3B, the Chilean voluntary pension savings, and then the Brazilian RPC. Those are ones that we've dealt with regularly here at the Wolf Group, and we know that they fall into this category. Obviously, there are others throughout the world, but these are just some common examples. Okay, so now that we've kind of gone through and we've looked at our pension plan, we said, is it a defined benefit, defined contribution, or self-directed? The next question is, where do we put this into the Internal Revenue Code? And really, you only have 3 doors that you can enter into. It's either going to be a 401A plan, a 402B plan, or a 679 plan. And when I'm saying these numbers, I'm talking to you as in my former IRS capacity. That's IRS code lingo there. But that's the best way that I can describe these plans. It's going to fall into one of those code sections. And that's typically how we talk about them when we're describing them to clients. So the 401A plan is basically going to take a foreign pension plan and harmonize it with a US plan. It's going to quote unquote qualify it with a US plan, which is fantastic. You can do rollovers to Roth IRAs. You can do rollovers to any kind of the US plans. However, these are rare exceptions. There's not many of them. The World Bank Pension Plan, for example, is a prime example of a 401A plan. It's a qualified plan under the US tax code. The problem with 401A is that I think if you read through it, I can't remember if it's 53 or 56 or 57, but there's 50 something different subsections that your plan has to qualify under just to meet these rules. So it's super difficult to get in under this. And then you kind of have to get the IRS blessing on that. And then there's still some additional reporting that you have to do, but it actually is the best of all worlds, in my opinion, if you can get the pension plan to qualify under 401A. The next section is 402, and in specific, it's going to be 402B. And this is where the majority of foreign employer pension plans will fall into. They're going to be called non-exempt employees trusts, so that's the terminology that's used within the code section. And basically, these can be defined benefit or defined contribution plans. And the big thing to know here, going back to my earlier comment about the contributions, if you had a defined contribution plan that falls into a non-exempt employees trust in code section 402, if the employee voluntarily, and voluntarily is the key word there, if the employee voluntarily puts in more, contributes more to the plan than the employer, you tend to have a very big problem that occurs there. So a lot of times when I'm doing outbound planning, so I've got a US taxpayer, maybe green card holder or citizen, they're moving offshore, they're going to enter into an employment contract in a certain country. And the first thing I ask them is, what type of plan are you getting into? And they respond, it's a defined contribution plan. I'm like, great. Okay, just make sure that you don't contribute more than the employer. Always set the contribution to either match or be just a little bit below, okay? If you go above the employer contributions, then what could happen is the amount above the employer contribution can be a foreign grantor trust, and that can lead to a lot of bad things. And we'll talk about how the impact of the foreign grantor trust plays out, because it's really the worst, one of the worst results you can get in regards to the non-exempt employees trust. So here's an example, and I've been told by a couple folks, I've been doing this presentation a lot recently. I just did it for the DC bar and then internally with the Wolf Group. And a lot of people have told me that this is a very complicated example. So I'm not going to get into the specifics of it, but I'm going to generally speak about it. So this is an example of something that we've seen a couple times. I used to do a lot of work in Switzerland, and I have had clients get into this, and it's a big nightmare. So for example, you have a US taxpayer that's moved to Switzerland. They've entered into the Swiss Pillar 2 pension, and somewhere within that, the company or the pension administrator has come by and said, hey, there's this great opportunity to maximize your pension and retirement plan. All you have to do is buy back the older years as if you had worked here in previous years. And you do that by making a voluntary contribution. The problem is that when you make that voluntary contribution, when you do that buyback, you've now basically split your pension from a US tax perspective into two different assets. So the first asset will always be that non-exempt employees trust defined contribution plan. The second asset, which is the buyback amount, becomes a foreign grantor trust. And now you have dual reporting, you have an administrative nightmare from a tax reporting perspective. And when you try to liquidate this thing, you'll end up with a pretty bad result, because you'll have a lot of tax basis built up into it. And you may have a double or even a triple tax event that occurs. Okay, so the foreign grantor trust, which is going to fall under Internal Revenue Code 679. So basically, if you're looking at your plan and it doesn't qualify under 401A, which most of them don't, or it's not some kind of employer plan where employers are making contributions in excess of the employee, then what's going to happen is you're going to be locked out of 401, you're going to be locked out of 402, and the rules kick you down into 679, and you get to have a foreign grantor trust. And the reason why it's a foreign grantor trust is that most offshore pensions are structured in a trust type format, or at least a trust type format from a US tax perspective. And some folks I know have tried to manipulate that or get around that by changing perhaps the structure, which is a very intriguing idea. But typically speaking, if it qualifies as a trust, it's going to fall into the foreign grantor trust rules if you don't qualify under one of those other sections. And I do know some people have gone to great lengths to basically, see, is it actually in a trust type format? And some have been right that it's not in a trust type format, and that has kicked them out of the 679 rules. There are some plans, specifically the Canadian RRSP and the Canadian RRIF, that used to have to file the 3520 and the 3520A, and then it was the 8891. These were foreign grantor trusts. They're basically foreign grantor trusts. The IRS has basically said, look, we know what these plans are. We understand what they are. We're going to give a pass on these. They did that back in 2014. There's a special revenue procedure that they passed where they pulled a carve out just for the Canadian RRSP and the Canadian RRIF. And so basically what that has done is it has kicked both of those plans out of 679 and back into 402. So you may not have to report the RRSP or the RRIF on the 3520 or 3520A, but you still have to report it on the 8938 Part 6. And so what's happened is that a lot of people have ended up with foreign pension plans that have been classified as foreign grantor trusts. Their tax practitioners have maybe filed the 3520, 3520A, which I can tell you right now, it's a difficult filing. You're basically trying to cram a pension into a trust filing, and it wants a balance sheet, it wants an income statement, and obviously those are not something that a pension is going to generate. You have to kind of make that up yourself as the practitioner. And so a lot of practitioners who maybe don't understand how to do the 3520 or 3520A or have a little bit of knowledge with them have submitted these on behalf of their clients. Maybe they don't understand the due dates, and their clients have gotten penalties or had penalties issued. And so what the IRS has done is said, look, we understand that, you know, we've already given relief for the Canadian pensions. There are other countries that we think should also get this relief. We're going to try to give a broad general relief based off of what we know from FATCA. And so basically they took some of the limitations from FATCA, some of the rules from FATCA, and they came up with this Rev Proc 2020-17, which bless the IRS, a good job, good start, but you know what, in my opinion, it doesn't go far enough. It doesn't cover enough. They really need to update this revenue procedure. They really need to write some new regulations. There are a lot of folks that are locked out of this relief. And I don't think that it's right. I think that a lot more people should be able to access this. So in order to get the relief from filing the 3520 and 3520A, to qualify for this procedure, first thing you have to note is that you have to be in full compliance with prior filings. This means that if in prior years it was a foreign grantor trust, then you need to file the 3520 and 3520A properly. It doesn't exempt you going backwards all the way. So you have to make sure you're in full compliance doing that. So maybe you need to do a streamlined filing or some kind of, you know, amnesty program to get caught up. But once you're caught up, if the plan meets these other requirements, then you're exempt from having to file the 3520 and 3520A. So the first thing to note is, are the contributions from the taxpayer from earned income? And so sometimes we see that, I know there's one plan we saw where there's a couple small government contributions, or there was one plan that we saw that had a couple employer contributions. I'm not concerned about those. I'm only concerned about the client or the taxpayer. And so in this case, a prime example of what would disqualify you is if, let's say I sold property and I take that capital gain and then I contribute it to my foreign pension. That would not be from earned income, and that would be a disqualifying event. The second thing is that the contribution limits have to be within the safe harbor. So you have to contribute less than $50,000 US per year, or a lifetime limitation of $1 million. Okay, so what I generally ask the client to do is say, hey, give me your contribution history since the very beginning. I want the book of Genesis on your pension plan. I want to know all the contributions. If you roll things over, I want to know what the rollover amounts were coming into it. I need to know all the specific details, and I need that in writing in case the IRS ever asks, did you qualify for this relief? Did you get it in writing? We want to have a pretty solid audit file so that they don't come back and say, oh, well, actually you don't qualify. You should have filed the 3520, 3520A. And by the way, here are all your penalties. So if you are going to get your client into this relief, you need to make sure that you have a really solid work papers and documentation to show that they do qualify. The draft instructions for the Form 3520 were published, I believe, back in September. And right off the bat, you can see that they have, the first thing literally on the form is this what's new section, and they already allude to the Rev Proc 2020-17, and that certain quote unquote tax favored foreign trusts are going to be exempt from filing. So the IRS is already linking everything into the instructions, which is good. It's helpful. It shows that the relief is out there and available. But again, I don't think it goes far enough. And I think this commentator, I got this from an article that was recently published. This commentator, I think, does a great job at kind of illustrating what I feel kind of the IRS is trying to do, which is they're trying to impose U.S. requirements on foreign pension plans. And so if we go back to one of the requirements of the plan, it talks about that withdrawals and distributions have to be based on age, disability, death, or some kind of early withdrawal penalty. And in some countries, they don't have these limitations. So for example, the Brazilian RPC, to my knowledge, doesn't have any of those limitations. And therefore, that retirement plan would never qualify under 5.03. So, I think this is a very US-centric set of limitations for distribution. I know that in some countries, they may have like an age of crystallization or a minimum age before you can withdraw. But most countries will not have provisions, at least from what I've seen, for death, disability, or things like that. Okay, so that's it for step one. So you've defined, you said, is it a defined benefit, defined contribution, self-directed? You've then figured out, is it 401A, 402, 679? If it's 679, you then said, hey, does it qualify under Rev Proc 2020-17? You've done your homework, you understand what you have. Now the question is, what's the tax rules going to be on this plan? How is the plan going to be taxed, if at all? So for qualified plans, which are the 401A plans or the World Bank plans, basically it will harmonize the plan with the US retirement plan. So the employer and employee contributions have deferral from taxation. There's no taxation on the earnings and accretions. We don't look through the underlying assets, and you're taxed on the distribution when it comes out. Okay, very, very straightforward. The non-exempt employees trust, though, carves out, it kind of goes into two different sections, okay? And the first section is going to be what we call non-highly compensated or non-HCE. And if you're non-highly compensated, which we'll talk about what that means here in a minute, then basically what happens is that the employer contributions become taxable. The employee contributions cannot be deducted, so if they fall into gross income. And basically you have to make sure that you're listing both of those as income on your tax return. The earnings and accretions are not taxable, so that's the upside to the rules. You kind of keep the growth in the plan as non-taxable. And then when you take distributions from the plan, what happens is that since you've been previously taxed on the employer and employee contributions, you have a tax basis, and that tax basis comes out as a non-taxable distribution. And then the earnings and accretions will come out as a taxable distribution because obviously it has not been taxed. The other good news to this is that the underlying assets, we don't look through to them. So there were some PFIC rules that came out in, I believe it was 2018, some regulations where it basically says you don't look to the underlying assets for foreign pensions. Although you need to read through those regulations very closely because there's some caveats to that or some rules that you have to follow. If you're HCE, so if you're highly compensated, this is where it's like the full penalty provision. The IRS does not like you, you're a highly compensated employee, and basically everything gets taxed. Employer contributions, employee contributions, and the growth in the plan is basically taxed on a mark-to-market basis. So you take the value at the beginning of the year, value at the end of the year, whatever it grew by, that gets taxed as what we call the vested accrued benefit. And for the most part, you have a full tax basis in your plan. And at the very end, when you take distributions, it comes out as non-taxable. Okay, so what is quote unquote highly compensated to the IRS? Well, in tax year 2020, that's going to be a salary of $130,000 or more. And so you really need to look at your 414Q tables to figure out what year you're dealing with. If you have an older year, you need to kind of go back in time and see what was highly compensated for that particular year. And it can be a very intricate analysis. I've had to go back into the 90s and the 80s and figure out the different tables that were back then. But the IRS has great historical records on all of that, so it's pretty easy to find. Another question we regularly get is, hey, I've got a defined contribution plan. I no longer work for that employer. How do I know if I'm highly compensated or not? And the answer to that is that you go look, just as I said, you go look at those older years and you say, okay, well, in your last year of employment, were you highly compensated? If you were, then you'll always be highly compensated. The other test that you have to look at is if you were 55 or older when you were at the company and you were highly compensated at any point in time, if you go over that threshold, you'll always be considered highly compensated for the IRS purposes. So there's a couple different things that we have to know about your salary history and your age and some of the former pension schemes that you may have been in. Okay, so we've kind of walked through, again, you've figured out what your plan is. You've done your homework on that. You're now looking at the tax rules. You've looked at the 401A qualified plans. I've just talked about the employer plans, which are the non-exempt employees trusts. Now we look at the foreign grantor trusts, and we can now see why these create so much havoc. So on this one, very rarely are you going to have employer-employee contributions, because a lot of them are self-directed, right? But if you did from a salary, then they would be taxable. For the most part, we're looking at the growth in the plan. And unfortunately, with a foreign grantor trust, the big issue is that it's transparent. And there's a full look through. You look through to the underlying assets. And for most pension plans, they're going to be invested in foreign mutual funds, which means that you're going to have PFICs. This is quite common with SIPs. This is quite common with Swiss Pillar 3. Sometimes though, like for example, in India, some of the foreign grantor trusts just have rate of return, so it's interest income, and that is not a PFIC, obviously. Or they'll maybe invest in a certain kind of bond. That's not going to be a PFIC. So at that point in time, it's a little bit less of a bad result. But the PFIC is what makes the foreign grantor trust kind of unpalatable. In addition to the 3520 and 3528, it can make it from a tax perspective very, very unpalatable. When you're doing your taxation and you've kind of figured out, okay, this is how I'm going to tax my plan, the next thing that you have to look at is, what are my options to mitigate this? How can I be more efficient with my taxation? Do I have any mechanisms that help me out? And the biggest thing will be the tax treaty, okay? And the tax treaty, there are different provisions within the tax treaty that can really help you out depending on where your plan is located. And so, for example, here's some article provisions from different countries that may allow you to defer taxation of the contributions to the plan, which is great because it somewhat harmonizes the plan with the US plan. So for example, I'm a huge fan of the UK treaty. I'm a huge fan of the German tax treaty. Obviously, the Canadian tax treaty is going to be a rock star tax treaty. But in certain cases, these treaties could really help you, defer those negative rules that I just talked about. There's also a couple of treaty positions that you can use to defer taxation of the earnings and accretions, so make sure you know those. In each case, though, when you're dealing with a treaty, you need to check the savings clause. The savings clause is typically going to be very prohibitive. I know a lot of people will come to me and say, I'm a US tax resident, I've got this going on, but I see that under the treaty, I can do X, Y, or Z. What they don't understand is that when you go to look at the savings clause, which is typically in Article 1, it'll tell you that if you're a US resident or citizen, you must disregard the treaty as if it did not exist. Now, it will go on to say there are some exceptions to that rule, but they're very minimal what the exceptions are, and you need to make sure that you qualify under one of those exceptions before you use that position. So, treaty analysis is a very intricate area, and I would not try to do it without knowing more about it or relying on an expert that knows how to do the treaty analysis. In-country rollover, so this is a great example of when the treaty can be super helpful. Generally speaking, if I have a foreign pension plan, and most people do this, right? They consolidate, they take their 1 or 2 employer plans and they roll those over maybe into a self-directed plan. When you do that offshore, it's going to be a non-qualified rollover because none of the plans are qualified. And so what happens for the most part is that you could have a really big taxable event. Basically, you just pulled all that money out of your pension. It's fully taxable in the US. And one of the saving graces is you have to check to see if your treaty has an in-country rollover provision. And the UK does. They have a fantastic one. So in the UK, you can basically consolidate your pensions and roll them over into another pension, a self-directed pension like a SIP, and you're fine. There's no taxation on that event in the United States. But just have to make sure that you know exactly kind of what your treaty says and what country you're working with. I will note that there is really, not to my knowledge, there's no way to really roll over a non-exempt employees trust or a foreign grantor trust into a US qualified retirement plan. So there's no cross-border rollover option that you can do. Some rollovers that give a lot of folks headaches are going to be the QROPs and ROPs. This was a hot deal, in the mid 2010s-ish. We saw a lot of folks in the UK that were rolling their pensions over to Malta or different areas. What happens is that even though you may get a qualified pension rollover under the UK treaty, you're still going to create a foreign grantor trust. So now you have that problem. And typically speaking, there's a lot of abuse between the Malta-US tax treaty with these types of assets. I generally dislike them. I know the IRS dislikes them. And I'm starting to get a little concerned now that Brexit is in the works, that perhaps even the UK HMRC may not like these. So I think that someone that maybe has a QROPS in one of these jurisdictions may want to, think long and hard about, how long they're going to continue to house this there, and if there are other options perhaps to move the product over into. Common question we get out of the UK is the 25% lump sum distribution. The snip that I have here for you is actually from a private letter ruling, which is one of the handouts. And it basically does a great job at talking about the savings clause and what does or does not apply. And basically here the IRS is saying, like, look, under the treaty, there is this provision 17.2 that says, you take the lump sum out, you're not taxable on it. Unfortunately, it's not one of the carve outs for the exceptions to the savings clause. Therefore, if you take the 25% lump sum out of the UK, you're going to be taxable on it in the US, okay? It's only in very rare circumstances that you would not be taxable on it. But for the most part, folks that are US tax residents are going to be taxable on these lump sum distributions. And I know that there's a lot of stuff out there where people have published articles saying that, that there's ways around this. I don't see how this could be true. This is basically straight from the IRS saying you can't do it. So be real careful about what you're doing there. I like to always do a tax treaty position for the most part, unless I'm doing FDAP withholding, which is a whole different topic. That's not really necessary. But for the most part, when I'm taking treaty positions on pensions, they're not really required. But I like to put them in there because I like to tell the IRS what I'm doing in case they ever ask. It's kind of like leaving a breadcrumb trail or showing the map, because you're basically maybe excluding certain items of income from taxation. And I think it's just an improper if you don't tell the IRS kind of what you're doing and why you're doing it. So for a rule of thumb, I always file the 8833 tax treaty position whenever I'm taking a pension position. Okay, so now that we've gone through the taxation, let's get into the reporting. And I'm going to kind of speed up a little bit here because we're about the halfway mark, a little bit over the halfway mark. And I do see some that we have about 19 questions already, and I want to maybe try to answer a couple of these. But for the reporting of plans, this is where it may get a little technically complicated, and I'm going to try to speed up yet slow down on some of this stuff. So, for example, the qualified plan is actually the easiest of all to do the reporting on. This is, again, prime example, the World Bank pension, the IMF pension. What you're going to do is you're typically going to, in certain circumstances, and again, there's a wide variety of circumstances that would require this, you're going to want to report the value of the pension on Form 8938 Part 6. If you do that properly, it should show the value also on page 1, Part 2. And then if you're retired from the bank, and you're getting distributions, it should also show the distributions that you're getting in Part 3, the gross amount, and kind of how that ties in on lines 5A and 5B of Form 1040. That's the 2020 1040. So that all needs to be on there, and that all needs to be tied in together properly. The FBAR regulations generally give a pass on reporting of qualified plans. And in general, I think most people have the thought that a pension plan doesn't get reported on the FBAR. But I can tell you that that there's a little bit of ambiguity when it comes to that. And in certain cases, I think it's merited. And I think from a conservative position, people should do it. And we'll talk about that here in a little bit. But for qualified plans, you don't report those on the FBAR. We know that for a fact. For the 8938, I just want to bring to your attention the potential penalties for not. I've had a couple of people say, well, what if I just start filing it going forward? What if I don't do it going backward? Well, I think that that's a kind of a bad take on reporting of the 401A plans or any of the foreign pensions. My advice is that if you have an 8938 delinquency, you should cure it while you still can. The IRS has been pretty relaxed on hitting people with these penalties, but that could literally change overnight. And so as you can see, they can be quite burdensome and onerous if they actually do decide to start penalizing people on this form. The other thing about this, which I've talked to the IRS at length about, and I've told them that it's going to be untenable at some point, is this weird rule they have about the statute of limitations in the Form 8938. And it basically says that if your 8938 is not complete or you didn't file one, then the tax return can remain open until you actually file it. And the 8938 was introduced as part of the legislation, the Foreign Account Tax Compliance Act in 2010. And so the form comes into being in 2011. That's when the form first started and the first filing requirement. And so interpreting this, you can say, look, you have to go back. If you had the filing requirement back to 2011, you need to go back to 2011 and amend your tax returns and report and make sure you close the statute. And at some point, we get to 2022, 2023, that's going to become untenable. Their 2011 return would not be in the tax software. You'll have to do it manually. You'll send it down to the IRS. They'll be like, what the heck is this? Why are you sending this in? I just don't think that that's a reasonable thing to have in there. And I would tell the IRS that they probably want to change the statute to 6 years. If they really want a longer statute, maybe change it to 6 years. Generally speaking, I tell my clients you have 3 options. You can go back to 2011, which I dislike, but we'll do. We'll do the last 6 years if you really want to be uber compliant, or we'll just do the last 3 years because that's generally the normal statute limitations for assessment. And then we'll file it under one of the different IRS amnesty programs. But I think you have to be aware of this caveat and this liability, and then just make an informed decision on how you want to approach that. The reporting of the non-exempt employees trust is going to be somewhat similar to the qualified plan. So you're going to do the 8938. You're going to report it on parts 2 and part 6. If distributions, it's going to go on part 3. The only difference with the non-exempt employees trust reporting is that in some cases, I believe it needs to go onto the FBAR. The FBAR regulations that were issued in 2011 are very ambiguous about this, and they basically go into this 50% or more beneficial interest test. And I think it's basically saying that if you have access to the account, they look at it as an account number, and that it should be reported. And so if you kind of do the analysis and understand what they're saying, they're basically saying once you can gain access to the account, you should probably report it onto the FBAR. And typically speaking, the rule of thumb is going to be the age 55, right? That's going to be the rule of retirement. And so for our rule of thumb, if a client is 55 years of age or older, we take the conservative position to report the pension on the FBAR if it's a non-exempt employees trust or a foreign grantor trust. The reason why we do that is because the FBAR penalties are crazy and they're regularly enforced. And if you've ever been through an FBAR audit, and I've represented many people on FBAR audits, there's really no way out. The IRS has the high ground. They can hit you with the non-willful failure to file penalty, or failure to file, or failure to report penalty. Or if they really, if they think that you've got a pattern going on, they can do the pattern. They can do willful for a lot of people. If you want to understand what willful does, you can just look at the DOJ website and see all the criminal cases they prosecuted. So the law is on the side of the IRS for the most part. There's some recent cases that have played out really well for FBAR penalties, but for the most part, it's a low threshold that they have to prove to hit you with one of these penalties. So in my opinion, there's no harm. Report it, avoid this issue. But if you're going to report it, make sure you keep your documents. And this is more of a my take on just all foreign financial asset reporting. It's incumbent upon the taxpayer, the individual person, to keep their records. You have the ultimate responsibility. You can't defer that to your tax preparer. I mean, obviously at the Wolf Group, we keep all the documents. If you needed them, we'll give them to you. They're on our systems. But you have the ultimate responsibility for your record keeping. And in my opinion, the easiest and best way to win an FBAR audit is if you get that notice that says, the first thing you do is get a notice saying you're under audit, please produce these documents. If you can literally produce those documents the next day or a couple days later, it's this huge sign of due diligence and good faith. You basically have distinguished yourself from the 10 other people in the same situation that probably don't have their records. And so being able to pass those records to the IRS and say, hey, here's the records, here's how we came up with the numbers we came up with, here are the accounts that we reported. I think that will be the best way to show them that you're non-willful or that you didn't do anything, untoward with the FBAR. Okay, I'm off my soapbox for the FBAR and moving on to the foreign grantor trust. This is where things get super tricky. So the foreign grantor trust requires the filing of forms 3520 and 3520A. This is a little awkward because these forms at the moment have to be mailed into the IRS. They cannot be electronically filed. They're separate from the tax return. And they also have different due dates. So for example, the 3520A is due by March 15th and the 3520 is due by April 15th. And you can extend them, and so the extended due dates are September 15th, October 15th. But The 3520A requires a special extension, which is Form 7004, whereas the 3520 follows the 4868 extension, which is your individual tax return extension. The problem with that, though, with the 3520 extension, is that the IRS doesn't really do a good job at double checking that. And what they really look at is page 1 of your 3520 and whether you checked the box 1K and filled out that little section correctly. If you didn't, I can tell you that almost 10 times out of 10, you're going to get a penalty for late filing, and then you're going to have to go back and show the IRS that you filed the 4868 and that you had a proper extension on file. Again, it's a manual processing. It's an actual human being at a service center. They're processing the return. The likelihood of them messing that up because you didn't check that box is pretty high. So that's one of the things. If I'm a taxpayer and someone's preparing a 3520 for me, the first thing my eye goes to is, did you file an extension? Okay, well then let's the box 1K check. If so, we've already overcome one hurdle and now we check the rest of the form. But that's a big, big thing. To go back to the 3520A extension form, the 7004, you can mail that in if you don't have what's called an EIN or employer identification number. But it's easier to get an employer identification number so that you can electronically file that extension. It's also better to track the form, if there's any issues with it, if you have the EIN. And so as a matter of policy at the Wolf Group, if you have the 3520A filing, we've got an EIN for you, and we're going to use that to do the extension. We're going to use that to do the filing for the 3520A to keep track of it. There are going to be some other things that are going to come out of the 3520 and 3520A. We're going to talk about that here next. But before we do that, I just want to give you an example of my internal checklist that I use for foreign pensions classified as foreign grantor trusts. So this is a checklist that I typically use for foreign trusts. It's a light checklist, but this is what I'm looking at when I'm talking to a client, and I'm saying, okay, what do we need? What do we got? Who are the owners of the pension, or who's the owner of the pension? Who are the potential beneficiaries of the pension? Who did you designate? What are the underlying assets in the pension? What are the contributions to the pension? If there are distributions from the pension, are there fees that have come out of that? Are there taxes that are being paid or withheld? Has someone created an income statement for the calendar year? Has someone created a balance sheet? If they haven't, then we definitely need to do that. But this is what kind of goes into creating that form, and it's very numbers driven, and you have to be really careful about making sure to notate the right things on there. The 3520A will produce what's called a foreign grantor trust owner statement. So if you don't have a treaty that can defer the taxation, you're going to basically recognize all the income in the pension annually. That's going to be reported on the 3520A foreign grantor trust owner statement, which is basically a K1. That then needs to go to Schedule E, Part 2, just like if you had an interest in a partnership or an S Corp or a U.S. domestic trust. And then that will percolate through the rest of the tax return as far as the income. You also need to make sure that Schedule B, Part 3, Question 8 is checked. That's a big one that a lot of people miss. But that's just kind of ticking and tying and making sure that all the reporting is done correctly. Here's what that owner trust statement looks like. Here are the tie-ins to the Form 8938. And this is critically important. We've come across a couple clients that maybe have reported the 3520 or 3520A. They maybe done it incorrectly. They've left certain things off. And, in my head, I'm like, oh, well, at least they reported the value. So maybe we're just making some cosmetic corrections. If we do streamline filing, perhaps we can remove this from the penalty base. But then the big question I have is, if the original preparer didn't report here on the 8938, does that disqualify them from removing it from the penalty base? I think this is an easy fix to do when you're preparing the return, and forgetting to do it could cost the taxpayer if errors were made. So make sure you're always ticking and tying the forms together, and that you're following, how those cross ticks work. The penalties for the 3520 and 3520A are quite burdensome. There's basically a three-part examination that the IRS will look at for contributions, distributions, and value, and whichever one is higher, or $10,000, will be your penalty. And in some cases, some of these are enormous, even larger than any FBAR penalties you might get. So that's why I'm so timid about doing these things incorrectly, or getting them in late, or sending them in with reasonable cause statements. The likelihood of it getting a penalty is huge. The 3520A has the same kind of run through. And so if you want to understand how the penalties work, here's an example of where that comes from. In some cases, especially if you're doing a first time reporting for a foreign pension classified as a foreign grantor trust, you can do this substitute method. The IRS is really trying to push this now more than ever because they're seeing a lot of people that are missing that March 15th deadline for the 3520A. And so basically, if you follow the substitute format, you can submit the 3520 and 3520A together by the due date for the 3520. But be real careful if you're going to do this format. Make sure you work with someone that understands how to properly put it together so that you don't get a penalty. And speaking of penalties, again, another soapbox moment here. This is just a breakdown of all the potential penalties by international form. The IRS loves their $10,000 penalties. I mean, that's pretty much the standard for each form. And hopefully this will kind of give you a good example of what the potential liability could be for getting a form, an international form, done incorrectly. And this is why at the Wolf Group, we do a lot of these forms. We have to put so much attention, time, and due diligence into them, because if you get it wrong, this is what the result could be. These are the basic, in my opinion, these are what I would potentially offer to a client if they have a compliance issue. Some of these are going to be more applicable than others, and over time, the usage of the programs will change. So you kind of have to understand the climate of the IRS to know which one of these programs you should go into, and make sure that you're keeping in touch with the folks down at the IRS and kind of what they're seeing and doing down there. So for people that have previously been assessed penalties for foreign pensions reported on the 3520 and 3520A, whether you've paid those or they're still pending, if you do qualify under RevProc 2020-17, there's a special section at the end of the revenue procedure that allows you to either abate the penalty or do a claim of refund, as long as that claim of refund is with the statute of limitations for refund. So the first thing I do when someone has a penalty and I think they qualify is I kind of put the case on two parallel tracks. One is I have my team do the analysis for the RevProc 2020-17 to confirm they qualify and that we've got good documentary evidence. The second is I will call into the IRS under Form 2848 and I'll get a full understanding of what penalties have been assessed, when they've been assessed, what's the statute of limitations for refund, all that stuff. I want to know more about those penalties than the client knows themselves. Assuming that they fall within the statute and that they do qualify, I'm then going to draft the Form 843. I'm going to do a basic explanation, but really where the proof meets the pudding is going to be that documentary evidence. I'm going to attach all of that and I'm going to send it down to the IRS. If my client is in dire need, maybe they have a levy coming up or some kind of lien, or they're in a financial hardship situation, I may then take that submission over to the National Taxpayer Advocate, explain the hardship situation that they're in under IRS Form 911, and submit it that way. Okay, a couple miscellaneous topics, and this is really more for the tax nerds or tax preparers out there. I have this question pop up to me commonly: what can I use the foreign earned income? If I've got a pension, got a client with a pension, we're going to be taxing the employer contributions, the employee contributions. Does the foreign earned income exclusion help us out? And the answer is that it can in some cases, it can't in others. And so typically you cannot use the foreign earned income exclusion to exclude the employer contributions, but you can use it to exclude voluntary employee contributions. In some countries, they have life insurance that's attached to the pension, or they may have life insurance as a wrapper for investments. That's what they typically call them, life insurance wrappers. When they're attached to pensions, though, now you've got basically two assets that you're reporting, or at least two assets that you're reporting. You've got foreign life insurance and you've got a foreign pension. And believe it or not, foreign life insurance has its own set of reporting rules. You have to report it on the FBAR and 8938 if it's got a cash value. If there are premium payments that are being made, there's a 1% excise tax that has to be reported on the Form 720, which if you look to the right of the slide there, you can see the exact section where that comes from. I know that this one always takes a ton of people by surprise. They're like, I had no clue you even had to do this for foreign life insurance. And the reason is because there are treaty positions that allow you to get out of that. And most of the countries have these. And here's a list of the different countries where you don't have to do the 720 reporting, you don't have to do the excise tax payment. You still have to file the FBAR and the 8938 for the cash value, but you don't need to really worry about the rest. Expatriation. So this always becomes a sticky issue when you have a foreign pension plan and you're trying to expatriate. The reason is because 99.999% of foreign pension plans are going to be what we call ineligible deferred compensation, which the current exit tax rules dislike. They hate that. And what happens is that you take the net present value of that pension, which can be quite large because you're looking at the value of the pension over your lifetime, and you include it as ordinary income. It doesn't go into the mark-to-market rules. It goes into this alternative tax regime. And some folks that may have thought, oh, I'm not going to owe any exit tax because under the mark-to-market, I've got this exclusion, $725,000 exclusion. They're caught off guard because they don't realize that the pension comes in as ordinary income and doesn't get the 725 exclusion. So this is an area that you have to be very, very careful with when people are assuming, oh, my exit tax is going to be quite low. In some cases, you can lower the includable amount, but you need to get an actuarial to get in there. And this is typically only applicable to green card holders. And what happens is you basically just exclude the buildup of the pension during the points in time before the green card and before becoming a US taxpayer. So those are areas that you have to be very, very careful with if you're on the green card and you've got a foreign pension and you're going to give up your green card and perhaps subject to the exit tax rules. Tips and final thoughts, and then I'm going to go over some of these questions. Documentation is key. So for example, when we get a new client and I'm looking at our organizer, we have a whole special section about foreign pensions. Anyone that's ever worked with us, you know this section, you've seen it before. But once I see that you've checked certain boxes, my first email to you is going to be, hey, what information can you get from me about this pension? I need to know as much as I can about it. If you want to put me in touch with your pension plan administrator, I'm happy to talk to them. I'd love to get a full contribution distribution history. I want to know the rollovers. I want to know what underlying assets it's invested in. If I can understand that, that'd be great. And it can take time. It can take some time to get this stuff. It's not intuitive. It's not something that most pension plan administrators, foreign pension plan administrators, get a request on. And so to start that process as early as possible can be quite valuable. If you're going to be trying to do this on your own, or you're a tax preparer and you're going to try to do this for your clients, my advice is try to follow the 3-step process. It has worked wonders for us here at the Wolf Group. And I think if you can refer back to the slides and perhaps maybe look at some of the rules yourself, it will walk you through what you need to do. Make sure that if you have a foreign grantor trust that it does or does not qualify for Rev Proc 2020-17. That's a huge, huge new thing, and keep your ear to the ground as developments come through. I know a lot of people didn't even know that the Rev Proc existed, and so they promised regulations, they promised updates. There are some rumors that perhaps some of the more common pensions, like the UK SIP, we may be able to go above and beyond the $50,000 contribution limit or the $1 million lifetime limit. But I'd like to see that in writing from the IRS before I tell my clients that they qualify. But there are changes, on the way from the IRS. They are trying their best to be helpful with these assets. If you're not a tax treaty expert, get one. Don't try to do that on your own. Don't try to take a treaty position on your own. It can be a very tricky thing to do. If you're coming inbound to the US, I would tell you that pre-immigration tax planning is worth every penny. It can save you a lot of heartache because a lot of people just come in, they don't do the planning, and then they've got all this stuff and it creates havoc on their tax return, and then they've got to figure out how to consolidate it while still a US taxpayer. Consolidating prior to becoming a US taxpayer can again save tons of heartache, tax fees, taxes in general, things like that. If you're taking an assignment outbound, maybe after COVID-19, make sure you understand what pension schemes you're entering into, what are mandatory, what are voluntary. I always tell my clients when you're in that foreign country and you're being offered X, Y, or Z, if you have any questions on what you're being offered, you're welcome to send the paperwork and the information over to me. I love looking at that stuff and getting an idea of what's new and what people are pushing out there. If you're doing the exit tax and you're a green card holder and you've got a foreign pension, you should get an actuarial analysis. We have several good actuarials that we work with. It's not something that's very burdensome in my opinion, and it can be very good on the final outcome for the exit tax. I think tax representation 101, always get your 2848, do your due diligence, get your transcripts, check your statute dates. Those things can come in handy. It can also help the client understand, where they stand at with the IRS and what's going on there. On the back end, if you do your 2848 correctly, you'll get all notices and communications, copies that go to the taxpayer, also go to the practitioner. So you become that thin red line between your client and the IRS. And then if you're non-compliant, you need to go back and clean that up. I can't tell you how valuable that is, from just getting straight with the IRS to sleeping well at night. I think that everyone that has a non-compliance issue should really consider getting back in compliance. I think it's a really bad answer to say, I'm just going to do it correctly going forward. That's all I got. If you guys have questions and I don't answer them in the next 3 minutes, you can email me. You can also try to call me, but email is the best way to get a hold of me. So let's see, let's go through some of these questions. Is the IMF pension categorized as a foreign pension? It sure is. It's going to be a 401A pension, and I think I may have mentioned that in the presentation. I have a small state pension from both the France and the UK. Yeah, so again, this is a very specific question. They're talking about public pensions from France and the UK. That's going to have to be a very specific analysis under the treaty to know if those public pensions, if they truly are public pensions, first off. And then second off, if you're having distributions from them, whether or not they're taxable. So question here, why do UK pension schemes reduce the transfer values so significantly from the reported market values? That's a great question. I don't know. I do have some contacts though that deal regularly with UK pensions, and that would be something that I think would be a good question for them. That's not something I would know though, as a US tax practitioner. Okay, so this is a question that's asking, what's the likelihood that the U.S. pension, that the code sections around the U.S. pension reporting will be updated at any time in the future? Will it be the next 2 years, 5 years, 10 years? I will tell you that it is my opinion that the IRS will do their best to update as much as they can through regulation and revenue procedure. The IRS has really, due to their lack of workforce, has really had to try other means of getting information out there, for solving issues, from informal conversations to informal letters to frequently asked questions, which is always it's not a good thing because you can't really rely on a lot of it. What I like about what they've done with the revenue procedures, that's a published revenue procedure, you can rely on that. It's published in the Internal Revenue Bulletin. If it's not published, you can't, it's out there, it's helpful, but it's not authoritative guidance that you can rely on. I have a feeling that we'll see potentially some regulations in 2021 that may be a little bit more helpful for some of the foreign grantor trust pensions. But as far as, Congress getting their act together and changing anything, that's a big question mark I have. And really, it would, in my opinion, it would have to be some of the tax writers would have to really push that on their end. If you look at the Tax Cuts and Jobs Act, they basically wrote that bill in a matter of weeks and put that together. And that's probably one of the reasons why they didn't consider the foreign pension, because they really didn't have enough time. If you go back to the 1986 tax code, it took them 13 months to put all that out and pass it and everything. And that's kind of why the Tax Cuts and Jobs Act and the old tax code have a lot of discrepancies to them, is because of how quickly they got the Tax Cuts and Jobs Act out there. Slides will be available to all participants. Like I said at the beginning of the presentation, we're going to send those out next week. Let's see. We have a question here about the QROPs between Malta and the US. I think we would probably want to talk about that one-to-one. Do we have a summary by country? I kind of have a summary by country. It's an internal document for the Wolf Group. I have thought about writing maybe some blog posts on some of the bigger countries, just to give my thoughts. So for example, India, Switzerland, UK, France, places like that. I just need time. I need time to be able to do some stuff like that. I don't know if we would ever release a full, worldwide country summary that would give all, our perspective on all of them. But, that's definitely something that has crossed my mind several times and is a great question. Does Spain have a tax treaty? It sure does. You can actually look that up. Spain definitely has a tax treaty. Can you cover the 25% lump sum distribution again? Even with the tax treaty, will it still be taxable in the US? Yes, the 25% UK lump sum is taxable in the US. I would say that's true for about 95% of all US taxpayers, maybe even 99%. And again, there will be an attachment to the presentation that is a private letter ruling that you can look at that basically walks you through the analysis with the savings clause and the treaty position. And so I would advise you to take a look at that. What are the tax treaty implications for a dual Canadian US citizen with CPP, OAS, RRSP, municipal plans, all that stuff? You know, that's a very interesting question. A lot of that stuff, some people will say does not need to be reported on the 8938. In my opinion, if you're receiving distributions from CPP, OAS, your municipal plan, I just report the annual distributions received as the value on Form 8938. I obviously report the RRSP on Form 8938, but basically none of it's taxable in the US until you actually receive the income. And if you're paying tax in Canada on those distributions, then you get a credit for it, obviously, in the US against the US tax. But specifically, I think to answer the question here, you got to go really into the client facts to be very specific on what the final treatment would be. Is the World Bank pension defined treatment likely to be changed in the future? What would prompt us to change? That I don't know. I'm not really into the inner workings of how the World Bank does their pension system. I know they've already changed the type of pension. There's the old plan and the new plan. Whether there's a new plan at some point in time, I'm not sure. I'm not certain, but I'm assuming as time moves on that there may be different types of pension schemes and coverages that are brand new and perhaps palatable to the World Bank. But I personally don't see any big changes in the near future. Is there a streamlined filing available for 3520, 3520A if missed? Yes, it's a great question. If you have a 3520 or 3520A, at this point in time, I would tell you, you almost have to do streamlined filing. It's the only way to avoid a penalty. You know, I think that using the reasonable cause approach, we've seen that has not worked out the way that the IRS intends it or shows it to be on the website. And I think that's poor form on the IRS part for doing that. They kind of put out there and say, hey, you know, if there's no unreported income, just go ahead and do the 3520, 3528, send in the statement of reasonable cause. But once it gets processed, they don't really follow their own rules. So I think for the time being, until they kind of get their act together, you should always do some form of streamlined filing or amnesty or hyped up amnesty program if you have a delinquent 3520, 3520A. Let's see, I'm only going to answer probably 2 more questions here. Is a pension taxable from Argentina based on work done before coming to the US? So, and I think I'll put this question in a different way. If I was a non-US person and I built up a value in a pension, a foreign pension, and then I come into the United States, do I then look at everything that was built up prior to coming into the United States? And the answer is yes. There's no exclusion for the amount prior, unless of course you're looking at the exit tax and the includable income. And some practitioners I know have even gone as far to say that the moment you become a taxpayer, you're basically taxable on the full amount of that pension inbound, which I don't think is I don't think that's the right result. I don't think that would almost be like an inbound tax, right? You take the value of the asset and you're fully taxable. I think that would produce a huge taxable event, and I don't think that's the way the rules are anticipated to work. And I think that would produce the wrong tax result, I'll be honest with you. Is there a tax treaty with Mexico, Portugal, and Canada? Yes, there is. There's tax treaties with all 3 of those countries. Last question, where do we insert on Form 1040 foreign retirement about the equivalent to Social Security benefit? That's so someone asked earlier about the country, you know, are you going to put up a country summary of the foreign pensions? I think the same question or the same issue for foreign Social Security, like what's includable, what's not includable. That's a very specific question as to what is taxable and what is not taxable. And I think I would need to know more about what your foreign Social Security would be before I could tell you whether or not it's taxable on your tax return. And with that, I thank you all for joining me today. I hopefully have not bored you, but kept you intrigued. I know it's a very difficult area. Like I said at the beginning of this presentation, the rules are super antiquated and they can be difficult to follow. It's a very difficult bouncing ball to walk through. But I'm hoping that today's presentation maybe has illuminated you and provided you with a little bit more comfort as to how the rules operate. And if you have any further questions, the ones that I didn't answer, I'll make sure to try to answer those on the handouts that come out next week. And if you have any further specific questions, please feel free to email me directly. Thank you.